Welcome back, all the supporters of 369 Financial. Happy that you're here and happy that we are nearly 100 days into the new year. The investment world has been quite interesting. However, if you remember the video from the beginning of the year and even videos from last year, I was expecting this to happen and I made strategic shifts with your investments to ensure that if what we're currently going through was going to happen, that we would be in a great position. And I'm happy to say that preparing for what we're going through now has allowed us, and it has allowed our investors at 369 Financial to not feel the effects as much as other people are feeling right now. I'm not going to get too much into the technical lingo of the financial markets, but one of the areas that we always want to look at is what have the prices of the investments been over the last 200 days on an average basis. And what we're starting to see is a lot of the great companies are trading below the 200-day moving average, which is telling me it is a potential opportunity to keep our eyes and ears open for when it comes to potentially shifting some more money into investments. And the way we were able to capitalize on not seeing as much of a drawdown as other investors are seeing here in 2025 is because we've made strategic shifts into really boring investments that focus on providing healthcare and insurance. Not very exciting at all. A lot of those investments have actually gone up this year, which definitely been helping us when it comes to ensuring not all of the investments are going down. So people that are investing purely in like mutual funds that are invested in specific indexes or exchange traded funds, if the whole market goes down, all of their investments are also going to go down with it. So we've been able to take strategic shifts and pinpoint exactly where we want to place funds within your investment account. This sort of storm that we've run into with these little turbulence that we've hit, we've been able to manage it quite nicely. I've been very proud of that. Through a lot of the research that I've been keeping my eye on, a lot of economists and a lot of experts have been saying there's a lot of what they like to call dry powder on the sidelines, meaning there's a lot of cash that is currently not invested. A lot of companies and organizations are unsure what is going to happen with all of these tariffs and what is going to happen with the tax cuts and deregulation. So everyone's kind of just sitting on the sidelines and figuring out like what the heck to do. And I read a recent report that the amount of funds or cash on the sideline has increased from about $6 trillion to currently around $7 trillion. So $1 trillion increase, which is starting to tell us that that money needs to go somewhere. Because if you keep the money in cash, even if you're earning 4 or 5%, you're barely keeping up with inflation, which they're starting to say that inflation is not accelerating. We've seen some bumps in inflation, but we don't see really inflation accelerating right now, which is also a good thing for the health of the economy. And there's a lot of uncertainty with the economy, with these tariffs and with the DOGE and Elon Musk. A lot of people are frightened that some of these political moves could place America into a recession. No one really knows though. No one knows when a recession could occur. All I know is from my experience in researching, when something like 2020 happened with the global pandemic, or in 2022 when the markets had a long period of uncertainty, typically these events aren't planned for, and people and investors, when they're assuming there's going to be a thunderstorm, sometimes nothing happens. If you've ever seen the movie Braveheart, I would recommend that right now we just need to hold. And we need to hold strong. And I'm super happy with the way all of our investments are positioned, because if the markets rebound, I believe that we're set up for success. If the markets continue to slide, we also have a lot of cash and treasuries and fixed income on the sidelines for our investment portfolios. So you may notice in your portfolio, if you log in, there's more cash than usual. That's by design. That allows us to make strategic shifts in the market and to hold strong so that we can figure out where exactly are the best places to put your money for the long run. There has also been reports coming out that some of the major indexes are expected to struggle. And that's because a lot of the indexes have very high price to earnings ratios. And all that means is essentially if you are buying something for $1, you want to look at what that dollar is worth relative to an investment's earnings power. And with the price to earnings ratios being elevated for the overall markets, we've been able to essentially lock in and find hidden gaps in the markets that we feel are great places to put money for reasonable rates of return for the long run. So with that being said, our strategy is set up for a heads I win and a tails I don't lose much scenario, because ultimately we don't want to see these major drawdowns of portfolios greater than the market. Because if we can see our investments maybe struggle, but not struggle as much with the market, we're going to be able to make up ground. And we've been making up a good amount of ground this year compared to last year when the markets continue to rally and we didn't see as much growth as the markets, but we saw steady growth. And now we're not seeing as much portfolio drift downward when it comes to your investments. All in all, with everything that's going on, I'm extremely happy with our position. I'm going to continue to monitor everything closely. Not if, but when there is an opportunity, we will be ready. And I'll see everyone next time. Bye, everyone.